All right, everyone. Well, welcome to a very intimate tax technical talk with our team here at TaxHack and a very special guest who will be who we will introduce in just a moment. Let's go ahead and get started, and let's kick this off by talking about what we are going to talk about. So today we are going to talk about the proposed changes under the Tax Relief for American Families and Workers Act. That is a very long title that makes you think that it doesn't have a lot to do with businesses, but in our case, it has everything to do with the small businesses that we serve. All of us on this call are very keen on our small business and entrepreneur community, whether it's clients or just being in the ecosystem. And this is a piece of legislation that we are going to talk about from a practical standpoint. So it's not just academically interesting. I think we'll stay away from that. We will talk about how it's actually impacting our clients and how we're talking about it as we look at, do we file now? Do we wait for Congress? Is the election going to change? There's a lot of considerations which we'll come into, and then we will wrap with Q&A from our very broad and engaged audience.
Great. So, we're a Tax Hack Accounting Group. We are an advisory first tax firm with a specialty on the R&D tax credit and a core focus on cost segregation studies as well. My name's Ashton. I'm in charge of customer experience and operations. We have Miguel Centeno, who's our managing partner, R&D specialist for many, many years since before the Tax Cuts and Jobs Act. And we have Paul Glantz on the line as well. He is the gold standard for what a CAS firm should be, offering services from tax compliance filings all the way up to CFO level services. And then on our side as well, we have Sean, who is an R&D tax credit specialist. He's been in the industry for more than close to 10 years and has just left the Big Four as a manager and has been joining our team. Lucy, who runs our marketing department, is also on the line, is going to be guiding us through the call today. So Miguel, I'll turn it back to you.
Yeah, and just before we get started, because we are going to put this out, we'll go through and edit it if there's anything that we trip on. We just want to get through a important disclaimer. But before we get there, okay, no, we'll go through the important disclaimer. This is general information, and if you run and take something we say here, you can't say it's our fault because our lawyer had us specifically call out that this is not advice. So there's always exceptions, and that exception could be you. Interesting tax fact of the day. We are testing Lucy here to see if she can keep up with where we're going, and we've purposely made this very challenging for you. So Lucy, you're doing a great job. Interesting fact of the day. In 1930s, the top marginal tax rate was, can you believe it? 94%. 94% on $200,000, which at first I read and I was like, that is absolutely ridiculous. There's no way it's true. Thank you for Lucy for, inflation adjusting that. That would be about 5 million today. So okay, so I felt a little better. Probably weren't as many millionaires, at least concentration of millionaires as there are today. So our tax rates, if you think they're high, not only look at Sweden, but look at kind of the pre-1986 Tax Reform Act. They were much higher. Let's get into our panelists a little bit. We're going to flip over. There we are. So we Ashton introduced generally who's here. Far left, that's who you're listening to, but more interesting are the two gentlemen that are new to these. Ashton, you've seen before, I'm sure. First, I want to introduce our very own and newest member of the team is Ishan. He's coming over from a much bigger formal firm, and I'd just like to hear, Ishan, how is it going transitioning in? What is exciting as you're looking at this kind of world with changing legislation, working with small and medium-sized businesses? What's What's top of mind for you?
Yeah, I mean, our environment as we live in it today, the tax environment, a dynamic environment. Things are changing, I would say every quarter for us. And I think what's been most exciting is the material impact it makes on smaller businesses, mid-sized businesses. You can really tell what are the implications of these changes, and what kind of meaning they have to these smaller businesses, and in terms of dollars, but also in terms of time savings and their ability to then put that capital towards what they're actually doing in terms of technology, R&D, and just into their operations. So that's what's most exciting for me.
Very good, very good. We just got a question from the audience. I just want to say, are you sharing the slides as the main screen? Because I think it's the speaker you are sharing. I'm seeing the main screen. Are you guys on your end seeing the main screen? Yeah, okay. Um, Thank you, Sean. And just because tax is kind of a funny business to get into, um, how the heck did you get into, fall into, trip into, find specialty tax and R&D tax credits as a career choice?
Yeah, great question. So when I was thinking about tax, I mean, there were kind of two pipelines, the income tax preparation, or business tax preparation, or sort of the more consulting aspect, which led me to R&D. And that's what I want to do. I mean, the R&D tax credit space, when you're working on these engagements, you're more consulting and planning and strategizing, and then going through the calculation. Whereas, income tax preparation includes some of the same, maybe just less of a consulting aspect. That was one reason why I joined R&D tax credit, that practice. And then the other point of it is just learning about new technology. You get to be on the forefront of what features, functionalities, products, platforms are on the
Yeah.
verge of releasing, have been released, or even, you know, instrumental updates that on items and products that we use on an everyday basis. So that was one of the things that intrigued me to joining the R&D tax credit industry.
No, that's a very good point. And I will say it's been for those that haven't met you, Sean, it's been very refreshing having another especially tax bro uh, here to bounce ideas off. We speak the same language. I think what your point on industry specialization is so huge. I think a lot of practices are general, and especially with kind of our tech clients, and because we have to interface with VPs of engineering or manufacturing leads, it's like if you go in there and you don't know anything about um, tech or code bases or code language or integration. It's like they're like, I'm not going to explain tech to you. Like these are often not the kinds of people who are very generous with their time. So I just want to reiterate, very grateful to have you, and you're absolutely spot on. Why we're here, why we're aligned is, kind of knowing the industry and then the ability to provide consulting when you really understand a space is just I think it's magnitudes of what you can do if you're just trying to take one general tax credit or strategy and you're trying to apply it to everybody, right? Because it's like you're trying to take a shoe and find different feet that it will fit versus being able to be a little more agile. So great to have you. And I'm gonna skip over Ashton because I talk to Ashton every day, and I want to highlight my buddy, the man, the myth, the legend, Paul Glantz. Share a little bit about your practice, Paul, and then I've got a similar career question. So, yeah, just tell us
Sure.
where you are now.
Yeah, hey, thank you for having me, Miguel. I'm excited to be here and share a little bit about my experience with what we're going to talk about. Yeah, and so for those of you that don't know me, my name is Paul Glantz. I am co-founder and director of tax at Walker Glantz. As Ashton mentioned, we are a boutique tax and CAS advisory firm that we lead with advisory. We also handle tax compliance, and we work with firms like TaxHack to help our clients with specialty tax such as R&D tax credits. So I'm excited to be here.
Yeah, we're excited to have you. And just for the audience, like I will say that we're our sweet spot. Back to the point we're making on industry specialization isn't just industry, but it's also size. And you can tell by Paul's collared shirt that, the level of clients Paul can deal with are more sophisticated. I think those that really want the white glove who outgrow us, we send over to Paul. I've no issue saying that to clients, and we're really grateful to have another kind of tax partner that we can refer work to and also exchange ideas. So great to have you, Paul. I'm curious. The number one kind of accounting professional question is, when you graduate with a degree in accounting, I presume you studied accounting. Let me know if you didn't. You choose between audit and tax. Like 90% of people I feel like choose audit. What called you to tax?
Yeah, I had this professor in college, and he was, I mean, he was a trip. He's like this dude from Ireland. He was probably like, 5'6", Irish accent, and like what he did is he had a firm on the side. He was a professor, but he also was practicing, and I just love the hustle because for our accounting or for our tax 101 and 102 classes, we were literally doing the tax returns for folks in his practice. And he was just like writing our time up. So I'm like, I love the hustle from him.
Wait,
I
so you
respect
were
the hell out
doing
of
the
it.
tax return
Oh
that
yeah.
he for his clients?
Yeah,
Okay.
for his clients as part of our coursework. So it was like I'm like, oh, this guy's yeah, he's got a good hustle going. So his passion for
I love that.
what we do here in tax, the majority for those of you who didn't major in accounting, the majority of your coursework is around financial accounting, managerial accounting, cost accounting. You take one, maybe two tax classes in undergrad. And then of course, if you go to graduate school, then, you could focus more on masters in taxation and specific corporate tax, individual tax, et cetera. But for most accounting undergrads, you're not really getting much exposure to tax. And so my exposure to tax was just this one professor in this one class I had, 2 semesters, and it was I really enjoyed it. The content was interesting to me. I loved that I had an opportunity to work with small business owners, individuals, and provide them guidance. And that was the most interesting part to me, is like interpretation of the law, taking this complex subject, breaking it down really simple to them, and telling them how they can make decisions in their everyday life that would lead to a reduction in one of their largest expenditures.
Absolutely. And in that theme, did you think that tax law was going to change this often when you got into the business?
I don't think anybody did. I mean, we went through, so when I started in tax 2011, we had a big kind of overhaul around foreign accounts and specified foreign assets and net investment income tax. And it was kind of a big change for the time. And that was where I entered tax, was like all of these changes were happening, and it was quiet for a little bit. Then came Tax Cuts and Jobs Act, then came COVID, and it was like new tax legislation. It felt like almost monthly during the pandemic.
Yeah.
And so there was a lot to learn, and it definitely kept it interesting and challenging. And I like a good challenge, but it wasn't what I expected. The last major overhaul before joining the profession was 86, 1986. And to come into industry as as an incoming staff associate and learning the changes that were happening at the time that I had joined the practice I joined, which is now Cherry Becker. It was an exciting time to be, and it still is an exciting time to be in tax.
That's incredible. Yeah, I mean, on the R&D side, I mean, we've had a little more updates. So it was like 2001, 2016. I think the Cuts and Jobs Act just extended provisions on expense treatment, but it also created the sunset. So yeah, we felt it too. The one I think on the income tax that I remember that hurt was when I first started, like my firm in 2016, was all the health insurance. And I think there
Yeah.
was also a net investment tax there as well.
Yeah, ACA
Obama's extra.
provisions.
Yeah.
Yeah, Section 1411. That was kind of the big thing that was happening.
No, absolutely.
Yeah.
And then I just before we move on, I'm curious, Ashton, what's your journey been as you're hearing tax? Like, how do you look at tax as kind of an insider outsider?
Honestly, I didn't realize how much strategy is actually involved until I got behind the scenes. I used to be one of those people that would just give my data, give my, my W-2s, my 1099s, my Excels, etc. with expenses, and just hope for the best. But now, based on this guidance, I like to meet with everyone at least in a mid-year and at least in a year end. And especially with the different ways that the tax codes change throughout the years, being able to take advantage of certain things, or unfortunately not being able to take advantage of certain things. So
Or
just understanding how much time you need with your advisor has been eye-opening for me.
and because you're in this space, are you like the worst client? Like you're just on your tax manager? Like why didn't you
Oh,
tell me about this? Why didn't you tell you?
no, no, I'm great. The only issue I have is you reviewing our book so I can get my tax return done.
You're talking about a partnership I have that we have together, just so everyone's aware we're not talking about um anything to do with tax hacks. So yeah, I am a partner that takes his time as K1. I would say like I'm the best client because by the time I get the return, right, like I'm done with tax season. I'm like I don't even want to look at this thing, Like I'm just like I tell Diana, I'm like it's just like let whatever. Like I know we've missed three things. I don't care. Just like file it, right? Like I've already paid. Um anyway, I think that I see you laughing, Paul, but I'll spare you that question. Unless you want to share. Are you the best client or the worst client?
Oh, are you kidding me? I think last year I did, I issued all my K1s for myself like 11:30, 12 at night on September 15th. I'm notoriously the last client that gets filed. I every client's taken care of, never missed a deadline with a client, but I am like on the fringe every single year just trying to get it done. Thought I got
Yeah.
ahead of it this year too. I had everything ready to go last month and then got hung up on an intercompany recon with my partner. So I'm
Yeah.
like, okay, yeah, I'm gonna push this out another month. So trying, still striving.
Well, I can relate to you there. That's what we're going to talk about today is to file or not, when to file, thinking about it. But yeah, I certainly relate. I think as a tax guy, you tell your partners that you do business with or ventures with, you're like, hey, I've got the tax, like we can save, 2 grand, just let my firm do it. And then they're like, yo, where's my K1? You're like, yeah, you'll get it on the 16th of September. Let's move forward. So all right, so we're here to talk about the taxes in Congress, and where it is right now is just some background. Like before we even talk about what is this thing, I'll just share that there is a piece of tax legislation which is very impactful, which we'll describe in just a minute, and it's already passed the House. I think it had the same amount of votes, Democratic votes and Senate votes, to pass. So it passed with bipartisan support. Um, and it passed in January. I'll also share a little bit of the history, as I was saying before, is that really a lot of the impetus for our segment of clients for seeing this go through is that there are provisions of the Tax Cuts and Jobs Act, which was signed into law 2017, went into effect 2018, that were always set, always planning on sunsetting. Um, Congress, in their infinite wisdom, said the numbers don't foot, so let's just phase out tax benefits that our voters are going to be excited about in 2 to 3 years. Who knows what's going to happen? Like we don't know about a pandemic or World War III. Who cares what happens, right? Like the election cycle is like 2 to 4 years, right? So they said, you know what, we're going to let another Congress deal with it. And surely the thinking was, especially when I talked to kind of old mentors and even folks in DC, I think it was like this would just be revised, like it would be band-aided and patched together so that it didn't sunset. So even last year, I'm almost embarrassed to admit it, but I'm sure I've done it already on our webinars. But I was convinced that we'd get expense treatment last year, that it would come
I think a
sometime in the
lot of people were convinced.
okay, well, thank you for that.
Yeah.
Like we were very public to, I mean, we've got some on the R&D side, like we go really big. So I mean, we've got some clients that are pre-SOX, will be publicly traded in the next few years that we were like holding the line, like it's coming down the pipeline. Yeah, Sean, you were at the Big Four last year. I mean, what were they saying over there? What were your thoughts last year before we even talk about this provision on 174 and expense treatment?
Yeah, no, it's a great question. I mean, we thought it would go away much quicker and much faster. Um, Although that was our outlook, we still, advise clients to follow the code and follow the regulations under Section 174 introduced under the Tax Cuts and Jobs Act. Because most clients are hesitant to because it, typically leads in an unfavorable expensing or capitalizing of your R&E expenses. But we thought it would go away much quicker than it is or it may.
Yeah. And I suppose, I mean, like when you're talking about big four clients, I mean, these are organizations that have VPs of tax, that have CFOs that, have been talking about these things well before they actually happen, where, our client base, who, I wouldn't trade for the world. Like I would much rather have my client base than publicly traded giant global conglomerate companies. And I'm from the big four, so I can't say that. Um, they're looking at the tax code when the return is like right in front of them. It's like it isn't until like April, the first week of April, that like clients even started looking at this. So yeah, I think there's a big gap in terms of like anticipating it. And I think, I will give a lot of credit. Like it does make sense to get ahead of it and say, hey, this is going to be the law of the land. We should have a plan to do things on 174. Paul, can you speak to the sentiment, if different, in kind of the more small and medium-sized business? I mean, was this anticipated, and was guidance different?
I think our firm was under the impression that this was going to get passed last year, then again early this year, and we were feeling pretty confident that we were going to see some changes. I could speak to, most small business owners that the implications of this not being extended is detrimental to a lot of small businesses. I think that the politics that are happening in Congress are hurting our economy. They're hurting our small businesses. They're hurting mom and pop shops. So the advice that we were giving around R&D was all last year, just kind of let's wait. We'll see something happen before the extended deadline. And when it didn't, obviously we had to file. We had some clients that deferred paying any tax because we were feeling pretty confident that it was going to get extended. And so obviously there was some implications there with cash flow that I don't think Congress anticipated, or if they did anticipate, they just didn't care enough that businesses were hurting like this. It became too much about politics and child tax credit, which we'll touch upon. But that was the general sentiment, is that this is going to happen. It's got to get extended. It's absolutely important for these provisions to be extended, bonus 174, et cetera, because our economy is relying on it. The United States as a leader in technological advances is depending on this legislation to continue to be innovative, continue to be investing in technology and continuing to lead the world in what we're doing. So yeah, our sentiment on this not getting passed was we were feeling pretty defeated, and a lot of our clients are feeling pretty defeated, and it's changing the way that they're operating their businesses.
And I think it's a really important point, to make a distinction between how it impacts operations for big tech versus, um, you know, just like your everyday, business. I mean, 95% of businesses are small and medium-sized businesses, and Google having to pay more tax, with their balance sheet. Like this isn't moving the needle. I mean, maybe it affects EPS slightly. It doesn't matter. But for a lot of the businesses we work with, um, you know, going from a, negative taxable income, meaning there's no tax, to adjusting up income, to have, even 100,000, that's like 30K if it's a pass-through entity. It's 20 something just at the federal level. in terms of cash flow, especially when you talk about the impacts of inflation, then it's harder to get debt, it's harder to get equity. We've talked about the difficulty in being able to raise new rounds if you're an existing VC-backed company, right? We're hearing a lot about down rounds. Cash is really hard to come by. So 20K being due like that, and it was due in April, right? And you actually have companies, small businesses, founders, small teams waiting for something to change by October. They've already spent that money. So by the time it gets to October, and we actually told them like, yes, this is the actual tax liability due. They were scraping for that. And it literally, I think, impacts run rate for a lot of businesses that, maybe are pre-revenue or even, $1 million, 2 million in revenue. So like Paul saying, I mean, it really does impact business. And for those that don't know, I mean, it's just the difference between deducting, you know, if you have $300,000 worth of payroll that is focused on the development of intangibles. What that means is now you have to divide that number by 5, and you only get a portion of that every year. So you don't get the full deduction. Your taxable income will be higher than if you're just looking at your profit and loss on a cash basis. So you're literally paying taxes on cash that you do not have. And I think there's a lot to say about how that really impacts small businesses. And like you're saying, I mean, does Congress not care? Is it not a priority? Is it that the Democrats wanted to have some vote getters in there with the child care tax credit? Like that was so important that we just decided that the difference of $400 in the credit was worth actually hurting millions of businesses across the country, in a country where, I mean, we do reward. The reason we have an R&D tax rate, the reason we have a practice is because we have consistently, many Congresses since 1986 have consistently voted to keep this credit in effect to keep development going. But now all of a sudden we've either fell asleep at the wheel or decided to stop to care. I mean, I don't know, but yeah, I mean, I think as we look at the future and this act, I mean, how important, Paul, from your perspective, your clients, like what are they expecting, and how important are you communicating this is to them?
Well, our firm focuses on business and individual taxation. I wouldn't say that we have a lot of clients, or maybe any, that are really candidates for the enhanced child tax credit. So focusing specifically on 168K, which is bonus depreciation, and R&D credits, I think that those are things that our clients are making decisions on daily in their business. Do we purchase new equipment? How does it impact us from a cash flow standpoint? Miguel, your example is perfect. Like, you spend $300,000 on payroll, and then you've got to capitalize it, and it increases your tax liability 60 plus K if you're a corp at 21% bracket. You got to come up with $60,000 more on top of the cash that you already spent, because you're not getting a deduction for cash already out the door. It's having a major impact on decision making at the small business level. So our clients would like to see bonus depreciation extended. Most of our clients are in Texas, so the considerations for bonus depreciation, they're really favorable. We don't have issues with state conformity like some other states, where maybe if you live in Connecticut, for example, you have different conformity with bonus depreciation at the state level. So we might look into 179 or a different section 179 expensing over bonus depreciation. But for most of our clients, 100% bonus depreciation is just what they've gotten used to. It's been in effect for so long that this phase out from 100% to 80% to 60 to 20 to 0% bonus in 2027, it's changing how they spend money, and I think we'll see the ripple effects of that in the economy when this spending starts to slow, because the tax incentive and benefits aren't necessarily there. So if you're on the fence about purchasing a piece of equipment, and it used to be like, yes, I could use this, and let's push it into this tax year, and let's get 100% bonus and let's reduce our tax liability so that we can reinvest those tax savings into our business operations and provide more jobs or increase our footprint or grow, right? And so those incentives changed, completely. So the decisions, I think a lot of business owners are just kind of tightening up. They don't know. There's a lot of uncertainty with the economy, a lot of uncertainty with tax law, and so it really does impact these small businesses much more than what you were stating, Miguel. Like Google's not really changing how they're doing business as much as a small business is. So yeah, a lot of things that we're thinking about from an advisory standpoint, and a lot of sitting and waiting, trying to figure out what's going to happen.
Well, and let's come back to impact. I just want to make sure that we get a more kind of double click view into 174, and then we'll touch on bonus so that those watching that aren't completely sure what's all going on here can kind of get it. But yeah, just high level, I think those are the two main things we're talking about from our small business, medium-sized business point of view is getting back expense treatment for R&D. That's 174, and then getting back bonus depreciation. So we're getting back tax treatment that, I think in our view, the economy was running fine, or at least from a tax perspective, business owners knew where the goalposts were and they knew how to operate. And now we've shifted them, but also Congress has also said we're going to move them back, and it hasn't happened. So hopefully you understand the impact of it as we're talking here. Let's move to the next slide, and I want to make sure we get some airtime on 174. And Ashan, I mean, just kind of your thoughts, like, you 2-3 kind of important points about talking about 174 now, how it might change, how you think about it would be great.
Yeah, so I mean, the landscape as we see it now, under the Tax Cuts and Jobs Act, as it was in 2017, require you to capitalize your domestic R&D spend over 5 years, and amortize it over 5 years, and then over 15 years for your foreign R&D expenses. So that's what was put into place at that time. And obviously, we've talked about the impacts it could make on tax returns, and then pushing you into potentially a tax paying position. And so, an unfavorable impact to small, mid-sized businesses, even large businesses that are spending a lot of money developing technology, spending a lot of money on engineering efforts and equipment, machinery, things of that nature. And so, what that's kind of forced into Congress is the Tax Relief for American Families and Workers Act in January 2024, which the goal of that is to go back to pre-Tax Cuts and Jobs Act, and where you're able to expense your R&D expenses and actually get a benefit for keeping some of that innovation, that R&D effort in the U.S. and you get a benefit for it, which was the intention of the R&D tax credit. And kind of the two things at play here are Section 174 being forced to capitalize that now, and then you have the R&D tax credit, which is a dollar for dollar cash tax savings. Those two things kind of canceling out each other. So it was against the initial intention of keeping the R&D in the U.S., keeping all the technology, the IP domestically. And so that's kind of about the landscape we're in now.
Yeah, and let's get a little bit into the debate that I think I know other practitioners are having as well. I was talking to a large regional firm on whether to amortize or not to amortize. I think it's very clear that our reading of the rules says that we amortize. Like, are we all agreed there?
That's correct. Yeah,
Yeah,
I agree with that 100%.
Okay. Where we're not agreed, and I'm saying we, like collective, we like large, is like whether we do it or not. Whether that's in anticipation that the rules will for sure change, and now we've signed a return that we knowingly like is incorrect. There's different reasons for it. I no, not there's different reasons, but there's different. I think the reality is there's different approaches. I mean, and I don't want to be controversial for that. So like, Paul, I mean, I'm asking you to agree with me, but I mean, give me your perspective. I mean, there are firms out there that are saying we're still going to take deduction treatment. Am I off
Yeah,
base?
I mean, we're seeing a lot of different things out there. And I say this from just seeing incoming tax returns for like new clients. Part of our process is to review the past 3 years of filings. It's something we always do just as a courtesy for like a new client to find opportunities. And what we're seeing is they may very well have R&D, but there is no capitalization of that R&D, or they definitely had R&D because they took an R&D tax credit, but there still was no capitalization, which probably is the more egregious offense. But there is different interpretations of R&D. I think some practitioners are saying, "Hey, without a study, I just don't know," and we're not going to recommend a study because we don't want to do an R&D. We don't want to take the R&D tax credit. So you see that there's definitely some fringe industries where you would certainly need a study to be able to do that allocation. I think most small businesses aren't sophisticated enough to be able to do these calculations on their own, and most practitioners, unless you're a specialty group like TaxHack, doesn't have the depth of knowledge to be able to prepare that for a client unless they do have a department that handles specialty tax. So we are seeing a broad range of
I don't
different
know.
interpretations.
It's like I don't know what R&D is anymore. You know, I used to recommend it. Now I'm like I guess we weren't doing it. Yeah, I think egregious offenders, you know, and Sean's over here like the rules are clear, but I think I'll just call out egregious offenders. I think yeah, if you take the R&D tax credit fully and fully deduct R&D expenses without a reserve, you know, I'll add that part. Like if you consciously take a position and you want to tell me it's a, you know, more likely than not, you know, circular 230. If you want to stretch into that, then it's like, okay, well, this is an uncertain tax position, and
Definitely UTP.
yeah,
Yeah.
definitely UTP. And like let's talk about having a reserve that if I mean, what if Congress comes out, right? Like we don't know what's going to happen. Like we've got this election. I don't know that, right? So it passed the House, hasn't passed the Senate. Like I don't know if the Senate's just like, yeah, we could pass this, but then we'd have to give credit to like the other guys. Why don't we wait to see if the, you know, House, if the components change and then different, like whatever the politics is, like I love about tax rules, like we don't care. Like I don't care what's going on. What's clear is like this is hurting companies and they're holding out on us. But what if they just say, you know what, we're gonna keep the prior years the same and new rules start 2024. Like now you've got all these companies that I mean this is easy. This is a like a low hanging fruit if I'm an IRS agent, right? It's like I've got an R&D tax credit, but no amortization on the balance sheet. Like is this crazy? Like I mean I'm seeing this, but like I don't know, Paul.
That's just, yeah, if from a service perspective, that just seems like it'd be a slam dunk. I think fortunately with the House bill as it stands, and Senate is supposed to be voting on that today, I don't think it's going to pass because it'll need 60 votes in the Senate. I don't think they have the support for that. And from my understanding, they don't have the support on the Republican side because of the enhanced child tax credit, which the Republican or GOP is on board with expensing 174 bonus depreciation, but they aren't so on board with the enhanced child tax credit. Now, I don't think that this is going to pass, but the way that the bill is currently written, fortunately, is they allow for an opportunity to either amend prior years
Yeah,
or take what they call a Section 481A adjustment, which is a fancy way of saying like a true up
yeah,
for the past 2 years, so 2022, 2023, if you've already filed. Go ahead and take an adjustment to immediately move all that amortization that should have been an expense if this did pass, and take it in 2024. So fortunately, we do have. They are giving rise to some consideration here on like how to move forward, which is nice because that tells me that if this does pass, then there is going to be some taxpayer friendly relief to make it all work.
Yeah. Yeah, I suppose, if you look at it like, hey, I took deduction treatment and, the bill passes, then I don't need to do anything.
No harm, no foul, because you would have been able to amend, and the code is kind of applying it retroactively. So yeah, so you'd be in an okay place. But if it doesn't do that, then yeah, there would be.
And I think the reality is, I mean, like that's probably a conversation, but it's like, is it a slippery slope though? Like if we just start like extrapolating what the tax code may be next year, and therefore taking positions on like legislative changes, like are we really controlling the process? Like is that really kind of like the profession? Are we exercising like the right professional duty? I mean, I think as a firm, we are saying like section 174, and if there is a change, we'll either amend or do a 481 adjustment. I mean, there's rules, and I think we've got to honor those. I mean, Sean, I don't know if you would agree with that statement, or would, kind of add to that in any way.
Yeah, I mean, I think there's two camps usually. It's one that would like to follow the way the code and regulations are written now and today. And there are some that would like to follow what they think the code or regulations will be at whatever outlook they have, maybe the end of the calendar year, potentially next year, right? So those are typically kind of the two outlooks I see. Um, you know, whether one's right or wrong, I'll leave that up for debate. But some think of it, following what the code says today, and some have a more long-term outlook and would, think something is going to happen or pass through Congress. And that's another outlook that I've seen.
Yeah, definitely. Well, just in general, I mean, I think, are we on the same page of, hey, like as a firm, we will 174 R&E at minimum, the amount that's on the tax, it's on the 6765. There is a process that I was hoping you could speak about to expand, based on what actually Section 174 says. Can you talk a little bit about that? The,
Yeah, yeah, totally.
Section
So
41 is really the starting point, but 174 is bigger than Section 41.
exactly, yeah. So if you think about Section 141 and your R&D tax credit, you think about direct R&D costs that are includable for the credit. If you think about Section 174, the way the code is written and based on some of the new notices that came out towards the end of last year, beginning of this year, it includes all of those direct costs, but also costs incidental to your R&D. So examples would be overhead, rent, utilities, network and infrastructure costs, things of that nature. Your contract research at 100% instead of 65%, like under Section 41. Um,
Oh, that's right.
and so it casts a much wider net than Section 41. So your baseline is to include your qualifying costs under 41, but then you have to also add on top of those your indirect research and development costs. And
And
so, there's an interplay between the two, and there are a lot of efficiencies, as you go through R&D tax credit engagements, you can easily build in Section 174 because it includes all that data under the R&D credit, and then there's just a little more additional data that you request, and then, maybe a couple questions that can be asked on top of that. But I think the key takeaway there is if you have qualifying expenses under Section 41 for the R&D tax credit, that automatically triggers, um, you know, Section 174 expenses and some more.
yeah,
Um, and that's just the nature of the way the code is written.
yeah, yeah, and I will say, I mean, I think like some folks looking at this, they're like, hey, why would we do an analysis to pay more in taxes? I mean, I think the reality is, if you are, going public, if you have shareholders, typically if you're at the level where you have a CFO, uh, they don't want any risk. They don't want they don't want to fly high with interpretations of rules. You don't want a UTP, especially if one of the things we always talk about is like, hey, if your journey is eventually to sell to PE, I mean, they look at this stuff to make sure that you don't have any exposure. And if you do have exposure, if you do this wrong, if you've got if you're in a review process, due diligence right now, and you've got R&D without any consideration to amortization, no tax memo, a sophisticated PE buyer is going to say, hey, we want a discount because you have tax exposure that we may eventually have to deal with in the future. Not always true, but those are the kinds of, I mean, there's a lot of reasons to get it right. And I just have to publicly say that because I've got a lot of, I think, Twitter pushback on like just do it wrong and deal with it later. So thank you, Ishan. That's very helpful. I think the other like easy add to this is the foreign. So oftentimes we ignore foreign for R&D tax credit. A lot of the times there is a good amount of foreign development, whether they're contractors or otherwise, but those need to be included when it comes to 174 and not deducted. Let's just because we're getting close to time, let's move over to bonus, and I'd like to kind of ask you the same thing, Paul. I think there's a few things on this slide. I mean, a few things that I saw with cost seg, QIP with commercial, a lot of things I think got really aggressive after Tax Cuts and Jobs Act. At least when I looked at the market. Did you see that too? I mean, can you share a little bit about kind of the change in bonus?
Yeah, the change in bonus specifically to QIP. Is that what you're talking about?
Yeah, that's
Or
just
just in general?
that's just an example.
Yeah.
Just in general, like what are like what's happening from a tax perspective, and then how is it impacting clients?
Yeah. So, I mean, obviously, bonus depreciation is just a big topic that we talk about with small business owners, and I kind of touched on that a little bit earlier, where a lot of business owners make decisions on large purchases based on these provisions and what the tax savings are and the timing of it. And when I say timing of it, that's like tax planning 101. It's, do we take a deduction now or do we wait for a change and maybe take a deduction next year, right? So our tax planning in 2022 was, if we had clients that maybe needed to make large equipment purchases, we were accelerating those deductions in 2022, replacing these assets in service in 2022. And in fact, we had a big research project with a client where we actually found a way to save them. It was in the hundreds of thousands. They had leased a building, and they did not obtain the certificate of occupancy till January 2023. But upon reviewing court cases and doing some research, we found that we could use a date placed in service that doesn't coincide with the certificate of occupancy when the assets were actually available for purchase. So they did about $7 million of leasehold improvement that we were able to push into 2022 for 100% bonus versus
80%.
80% in 2023. So you can see there's like material implications for this. And so the tax planning in 2022 was trying to make these purchases before year end, place these assets in service to capitalize on 100% versus deferring the purchase to 2023 with 80% bonus. And I think even now with 2024, 60% is not that great. I think in my career, we've seen bonus typically at 100% probably for most of the time, and maybe 50% some portion of the time that I was in practice. But 60% is not very favorable. So it's, what we're seeing is that clients are a little bit more hesitant to spend unless we know that, we are going to see this change happen. And the way that we're presenting this from a planning perspective to clients right now is, I just don't think, and I was wrong last year, Miguel, when I thought this was going to pass. So I could very well be wrong again right now, but I just don't see this legislation passing with the election looming. I think if the Republicans feel really confident that we're going to see a Republican presidential administration, then they're going to feel a little bit more confident that they could push back on these provisions to get more of what they want. And I think on the flip side, the Dems right now are trying to force a vote in Senate today to just to get a consensus on where everybody stands so that the voters know where these candidates stand on these issues. And it might
Yeah,
not,
just
it's
for
not
show.
totally fair because it might not be a full picture. Like I think there's a lot of people that are in favor of the business provisions. From what I'm reading, it sounds like the individual provisions, specifically the child tax credit, are the hang up for a lot of individuals in the Senate right now.
Yeah, I mean the passed the House in January. So
January 31st. It's been sitting here for months, and
yeah.
with Senate set to go on summer break next week, they're not going to be in session. I just don't see that this gets passed or debated or changed between today and tomorrow, and I don't see that it will be a priority before November.
And therefore we have to
Businesses
file.
suffer and our clients suffer, and it changes how we make decisions on, placing assets in service in 2024 or waiting until 2025 if expensing provisions happen, or if, there's some, way to have some sort of retroactive relief in the final bill that gets passed.
Yeah, and I think the timing is important because, we've got to file returns, 9/15, 10/15, with a lot of these provisions, right? So
Mhm.
the hope was that we'd get some kind of clarity before we, hit that file button, and it would save us work on whether it's truing it up in the future or, going back and amending it, even if it's superseding it, like you can um, kind of change a return before the filing deadline without amending it. Like that goes away if we're waiting for the November 4th or whenever it is election, um, as the kind of milestone. So yeah, it really is unfortunate, especially on the bonus side. And I think the point is, I mean, like, look, we're going to file these returns. We're going to determine final taxes owed based on the expiring provisions of the Tax Cuts and Jobs Act, and not based on, and you can tell me if you disagree with me, Ishan or Paul, but we're not filing returns on what the legislation might be. We've got the law of the land. We're signing our
Yeah.
names on these returns, and we can't be creative.
Yeah, I'm in a full agreement with you, Miguel. We're doing the same at our firm where we're interpreting the law as it is today. We played a little bit of a waiting game last year. It didn't reflect really positively on our government or or us as professionals when we were feeling really confident that this is so necessary that this gets passed. There's no way it doesn't get passed. But obviously, Congress and our politicians just had different plans and different politics at play than the people that this bill is designed to serve.
Yeah, yeah, it's unfortunate. Um, yeah, I mean, we can move on to, I think, just closing thoughts. I hand it over to you, Sean. I mean, um, your closing thoughts as you look at, 174 as a process. You got to do it. What do we do after? I mean, just where's your head at with where we're at and where we're going?
Yeah, I mean, I think where we're at, like I mentioned earlier, I mean, as it stands today, we got to go through a 174 process and get the 174 expense amount correct, um, and get it on the return, favorable or non-favorable. I mean, that's the way it stands today, and especially if we're going through an R&D tax credit process already, it makes the 174 sort of engagement from a project perspective fairly streamlined, fairly straightforward. And you have just built-in efficiencies doing both at the same time. Where we're headed, we'll have to see. I mean, we've as an accounting profession and industry thought it was going to go away a lot earlier. We've been wrong or hopeful once. I don't know how hopeful we'll be this time, but with the relief fact, we have some hope, but it's hard to tell where we're headed. But as it stands now, I think the right thing to do is go through that Section 174 process and get the correct amounts on the return, along with the R&D tax credit if those are applicable, and just have a clean slate.
Yeah, I fully agree with you. I think that if you're going to follow the law as it's currently written, and capitalize 174, you should also definitely have the R&D tax credit to offset some of the
For
tax
sure.
burden that you're going to realize. But it's still playing out to see, which clients that may be eligible for R&D and may not have done a study to determine if they have R&D, what method they will choose. And I think a lot of those clients are probably pumping the brakes on doing a study because uh, they don't know what it's going to uncover, and they don't really know how much R&D they have under current legislation. So I think this gets extended. We'll see a lot more clients looking into the R&D tax credit benefits, knowing that they're not going to get hosed on a capitalization of these expenses. Miguel, what you referenced before, a business that has 300,000 of wages that now has to capitalize and doesn't get that as an expense, even though it was cash out the door. Those are the clients that are going to probably take a little bit more of a wait and see approach.
Yeah, I certainly agree. Certainly ready for the windfall when we can say, hey, R&D is not going to, right now, I think the market kind of feels the small business market feels that R&D is a risk. And I think we have to do a lot of education, what we're doing here. Ishan, you're doing a great job kind of explaining that. Like the direction of the impact is that 174 is tax treatments. It's, book to tax adjustment, really. It's treatment of the accounting, and it's related to R&D, but it's really kind of independent. And the kind of flow is, in some ways, is you do an analysis, determine what you need to capitalize, then you do the R&D to offset that increase in income. I think a lot of the times, they're kind of thinking, oh, if I take the R&D tax credit, then I have to do a capitalization of my development costs. But it's really the other way around. It's, hey, if you do development, black or white, you do have to amortize. And number two, what I'll share is like if you have done an R&D study every year and have had a sizable tax credit every year. I mean, again, talking about like IRS enforcement and kind of the things that they look for that they're easily able to do is just look for the high credits that go to zero in starting in 2023, 2024, and then come back 2025. I don't think that's a very safe bet. I think it's kind of I think it's
Consistency
kind
is
of
always
risky.
key with anything IRS. So picking that accounting method and moving forward, yeah, I fully agree that if you've recognized credits in the past, you should have capitalization and credits going forward, or at least capitalization.
Yeah, yeah. Well, fantastic. Ishan, Paul, you've both been amazing guests. We're gonna wrap it here. Thanks again for your time. And as always, Lucy, thanks for being the real star behind the scenes.
Thank you, guys.
All right.
Yeah.
All right, guys, have a great rest of your day. Don't forget to
Everyone.
file your
All right.
taxes.
Thank you.
Thank you, guys.
Cheers. See you.